So I'm with a group called the Midwest Renewable Energy Association, and we've been doing education and market development in renewable energy in the Midwest for 27 years. Over the past 6 years, we've been a fund recipient from the U.S. Department of Energy, working on what they term the soft costs of solar power, which are basically people. I think a lot of you in this room probably represent high transactional costs in deals. Congratulations. And that has been true for clean energy transactions. And so we have, for example, over the past 6 years, engaged jurisdictions, including the City of Chicago, to reduce permitting time for solar PV systems, update planning and zoning, work on financing. We've done group aggregation, for example, of municipal procurement of solar power in Minnesota. And so have been really focusing on, in recent years, solar and have some experience in wind. And now we are a fund recipient of the U.S. Department of Energy, looking particularly at the university market segment as a high potential investor in renewable energy deployment. And as part of that, we were involved in the Clean Energy Working Group. I want to congratulate George and Tony and Megan and others that worked on the paper. I think it's a really great first start. And I see there's copies on your table, and we may or may not address everything in there. And I believe that they will post it on their website and send that out by email also. So I guess to introduce this panel, you know, maybe I'll tell a story. So about 3 years ago, as an educator, I think this story has two purposes. One is kind of a warning to you all as investment managers and university leadership about the perils of the divestment movement for you, and also kind of like the formative nature of where this panel stands. So about 3 years ago, I was in a facilitation, and they showed a video, and it was a video of this couple, and they were carrying a piece of firewood. And they went to graduation ceremonies at Yale, Harvard, and MIT, as I remember, and they waited for the recent graduates to come off the stage. And so there they were in their caps and gowns, America's youngest, brightest stars, and they handed them this piece of firewood, and they said, "Where does a tree get its mass from?" And I'm not going to ask you all that question, but I want you very smart people. I've noticed this over the past few days. But I want you to get that answer in your mind, okay? Where does a tree get its mass from? And don't be honest with yourself. Think about that, right? And you know, it was kind of like gotcha journal. It's like trolling somebody by Twitter, but you have to actually get dressed and go somewhere. And they did not come off looking good, but I'm sure that they picked the students in particular that didn't know the answer to the question. But so you have that answer in your mind. I want you to do this. You have to humor me because I have the microphone. Just do this, please. Just do this. All right. Ready? That turns into wood, right? But students didn't know that. They all thought that, you know, it came from the ground, the soil, and that's where the tree got its mass. Where the tree gets its mass from carbon dioxide in the atmosphere through this process of photosynthesis and respiration. And it's just a little bit of gotcha journalism, and I think that's a good analogy for what this panel is that type of understanding is formative. It's a formative understanding to, for example, climate change, how the atmosphere interacts with all natural spaces. And this panel's more formative about what are the basic ways that university endowments can invest in clean energy, from probably more traditional ways of engaging an investment firm that looks at private markets and bonds, to newer ways where endowments can invest directly into projects and contract with agents that are leveraging the tax credits that are out there for power purchase agreements to lock in power prices. And so a number of the speakers yesterday addressed some of these issues. I think we'll have a speaker today from Bloomberg. They've been out in front of the real opportunity in their new energy finance division about all the opportunities there, and I feel like we are at a very interesting point in time where I believe it was a speaker yesterday from Goldman Sachs had said that impact investing occurs when markets are growing, costs are going down, and the people with deep pockets aren't investing yet, are still overlooking the investment. And that kind of is the opportunity for universities in this new space. So Without further contextualizing, I think we'll jump into the panel, and I think we'll start. All the panelists today have a short presentation that they'd like to start with, and then we'll get into the discussion. So we'll bring them up one at a time, and they'll give their presentation, and then we'll take questions and discussion. So first would be Ken Locklin from Impact Investments.
It's terrific to be here. I love these events. I love being in Chicago because there's a special energy about the city. I was saying to somebody at the break that I think I've been to 6 of these, I think. The energy, the quality of the questions and the energy of the interaction and discussion in the room is certainly as good as any. I think I might argue it's the best, maybe even better than the very first one. And this will satisfy you, I hope. It's substantially better than the one we last had in California with all those green folks who were out there and feeling very, patting themselves in the back for how advanced they were. So congratulations to everybody here because you're doing a great job of wrestling with some very tough questions. I'm going to try and provide a quick frame of one of the elements of the investment universe in which you can involve yourselves over time when you start looking at clean energy, and that's the listed equity, the stocks side of the investment, what many people think of when they first hear the word invest. You're actually going to get a better framing from John in a minute, who's going to help you see where all the different sectors fit. If you're not investor professionals, you'll get a better idea of all the choices. But let's start with this because it's pretty straightforward. George asked me to talk about clean energy, and when we say clean energy in this working group and in this organization, we mean the combination of renewable energy and energy efficiency. So those two together make up the clean energy universe. It's an exciting place to work. It's a place that I have worked for the last 25 years, and my firm, Impax Asset Management, has been very active in this arena since it was launched almost 20 years ago. Impax is an investor, London-based, manages about $6 billion, exclusively in environmental markets and climate solutions companies and projects. That's all that we do. We manage about 30 funds across 6 major strategies worldwide. They're all fossil-free from inception just because of the fact that we're working in environmental markets and climate solutions arena. And they have over time, those individual funds over time have met or beaten their sector and their market benchmarks quite consistently. So listed equities, buying stocks. It's something we talk about at the barbershop or in the cab. It's in some ways the easiest kind of retail investing. In this space, in the clean energy space, it's very demanding. It's not simple. A lot of money has been lost in this sector, including by people who are very proficient at doing it, and that includes us. So I would argue this is almost in the category of don't try this at home. It is true, it's an interesting market, but it's possible to do well, as we'll point to in a minute. I think that we have to recognize this is a very young sector, and young sectors tend to be volatile. And in the form that we know it today, it's really only about a decade old, maybe 15 years if you stretch it. It's still moving very fast, consolidating, companies entering and leaving the market, bankruptcies, collapses of some major players in the market, and brand new players coming together, merging. So we need to understand that those kinds of markets inherently are more challenging. We also have to recognize that because these markets are immature, they are often impacted by regulatory changes. In particular, the renewable energy market can be driven up or driven down by shifts in the regulatory markets in which they operate and the kinds of incentives that are out there. That isn't so true for the energy efficiency markets, interestingly, but it has been an issue when we look at the way renewables have performed over time. It's also the case that a number of these markets are quite narrow, made up of a small number of firms. The original equipment manufacturer, OEM markets, Tesla has a way disproportionate percentage of the market cap of the electric transport industry, for example. It just doesn't make sense to have a company that's that big in that one sector when other companies have little tiny slices of much bigger firms. And it unbalances the way the sector performs because Elon Musk can give a lecture about going to Mars and everybody either buys or sells the stock and nothing has happened to Tesla at all. So we have to be careful when we make investment decisions about what's underpinning the longer term growth. Given that, the results really aren't surprising. Let's see if we can look at those. And I apologize for the spaghetti, but I'll help disentangle it. So 10 years, 8 indices that are relevant to our conversation today. The very worst place to have invested over the last 10 years among those 8 is in coal. Bottom line, dashed black line, global coal. If you bought coal 10 years ago and you held it, I'm sorry. Interestingly, I've surveyed some major investment advisors who have clients worldwide. Coal stocks lost about 60%, 50% of their value in an 11-month period. But they kept going down after that. And I asked that advisor, who knows more people who manage more money than anyone I know personally, how many of the clients that he knows who got caught in that first drop then got out, sold out, because the sector has lost another 40% since then. His answer is exactly nobody that he was aware of actually sold. So it's a very interesting challenge. I hope you weren't in coal. If you were, it's a little late. You might as well sell now and take all those advantages. The next worst place to be was Brent crude. Also a surprise. None of us would have expected this. In fact, our own internal analysts didn't expect it 6 months before it happened. So this is just tough stuff to call. The next worst place, which is the pale green line, third one up from the bottom, was renewable energies over time. Last 10 years, as a composite, all of the major renewable energy companies lost money net over the last 10 years. So if you bought the index, you didn't do very well. I actually, when this index was, not this index, but a comparable index was launched by Bloomberg, the founder of the company that was designing it was a friend of mine, and I called him and I said, this is great, I'm going to buy it, I'm going to put everything into this because I know this is going to go. And he said, you are crazy. You know, you make your living in this, don't put any money in this index. And he was right. It would have been a very sad investment. So you have to be careful. Can you make money? Absolutely. But there's a period, and that particular line makes up a third of our global portfolio probably, and yet we are outperforming the broader market. We've had periods, if you look at that peak around January of 12 to about May of 14, that bottom green line, you see how it dips and stays down. Many of our strategies, which notionally include renewable energy investments, had zero exposure to renewables for a period of up to 3 years. We couldn't make the market numbers make any sense. Now we think we see opportunities, but we're very selective. So, tough market, be careful out there. Next category up, if you had just been holding the broader energy market, which is actually all of the broader industry of fossil fuels, MSCI Energy, you would have done a little better than renewables. But you wouldn't have done as well as if you had been holding simply the MSCI All Country World Index, so the broader index of the economy. If you jump up to the second line from the top, the FTSE EO Energy Efficiency, that's the little green line which is sitting on top of a paler green line, which is above the blue line, just in sort of the middle there. That's the Energy Efficiency Index. It's done very well. It's outperformed the broader market quite consistently over time. It's been less volatile, but it has followed that market fairly closely. Right below that, and almost superimposed on it, is the FTSE Environmental Opportunity All Share. That's the composite of all of the broader environmental markets, indices including water and sustainable ag. They all relate to energy, but if you add them all up, it has outperformed the broader market. It substantially outperformed renewables. So there are opportunities to invest and to invest successfully, but with care. The next part of our conversation is we're trying to also invest for impact. Investing for impact in listed equities is a challenge. We also manage private equity investments, and those are in literal wind farms. They are in renewable energy projects. We're investing in the solar field or in the wind farms, the turbines. It's really easy to measure the impact. It's generated hours of clean energy. It's any impacts on the soil in the area and so forth. Very straightforward. With listed equities, much tougher. A typical listed equity company does a lot of different things. Only a portion of that is often related to renewable energy or to energy efficiency. It's tough to disaggregate those pieces. It's really a challenge to understand where the profits are coming from. And that makes it hard to see or track impact over time. So we have spent a fair amount of time working on that. The folks at the Global Impact Investing Network came to Impax and awarded us their first impact investor allocation designation as listed equity manager. but they said we had to do a better job of coming up with impacts. We spent 2 years looking at all the investments of all of our companies in listed equities and disaggregating literally by product, every product produced by every single one of the companies in our universe of investments, and then adding up the environmental impacts of those products as actually deployed as best we could calculate it. The result there, you can see on the energy efficiency side, reduction in carbon emissions. In the water side, millions of gallons of water treated, also clearly impact reduced in reduction in waste, and generation of clean energy. So it's possible to make these investments to identify the impact, publish the information, which we do. It's validated by Ernst & Young. We make it available globally, and we welcome folks coming and taking a look at it, providing improvements over time. So I guess that's the net really over time. Can you invest successfully? Yes, with care. Can you invest for impact? Yes, with care.
Hi, I'm John Chaimanis. I'm with Kendall Sustainable Infrastructure. We are a fund manager, and we focus on owning underlying assets, real assets, sustainable assets. Primarily, that looks like solar projects, wind projects, hydro projects, but the direct investment in the underlying asset. We're not participating in other aspects of it. What I'm going to talk to you about is really the mental framework for investing in clean tech and clean energy. I'm going to try to put a lens on it with private investments in particular. But I think one of the things that Ken showed was probably the most important point of all, which is clean tech, clean energy is probably a bad group to think of as an investment bucket to put yourself into. Renewable energy stocks include manufacturers, include developers, include asset owners. Those are materially different business models. And what you really need to do is take away the fact that you're even thinking about sustainability or impact and look at the underlying business. You're investing in a manufacturing business that makes solar panels or wind turbine blades. And what are the risks and rewards inherent in that? That's sort of point one. That's also from yesterday. I think John brought that up. They're not all the same. The second thing I want to talk about is you as institutions, as endowments, as universities, you have really two buckets primarily that you can invest from in this revolution, call it a revolution, in your day-to-day. Operations bucket and your endowment bucket. And they operate differently, and the level of impact you can make is different. The level of direct feedback you can get is different. And then the third thing is I want to bring it into projects and try to get that far in a very short period of time and describe when you invest in a project matters. Okay? The 20-year PPA in principle makes a lot of sense to people. They say it's a financial product, that's great. Well, getting to that 20-year PPA is a very long and bumpy journey in which lots of money is lost. So I want to try to talk about that. So let me see if I could cruise through these. I think I touched on these already. This is a conceptual rendering, okay? These numbers are not precise, but what this really does is try to put a universe around sort of this clean energy, clean tech, renewable energy, and break things down more into what you're actually investing in, what business you're investing in, what risk you're getting. So the blue line is your risk of loss, okay? And the different bubbles represent different types of investments. Starting on the far left, you have the pre-commercial new technology, something like a brand new wind turbine that hasn't been built before, or a new battery that's sort of nascent, and we're talking about venture capital. Somebody has a great idea, maybe they have a patent, okay? The next one is development stage projects. Nothing to do with the first category. They both fall under clean tech, clean energy, but they don't belong in the same investment bucket. The second one is development stage projects. These are projects where somebody says, I see a green field and I see a wind project. That's early stage. A lot of money needs to go into improving that, to get a lease, to get a permit, to get an interconnection agreement, to sell the power, to move it through its stages. There's a high risk of loss in those. Most developers would probably say their pipeline starts out with 10 projects and ends up with 3 good ones at the end of the day. That's losing 70% of your investments. Hopefully they're good at managing. Then you've got your sort of clean tech public equities right in the center there, kind of a big bubble. You've got, both sides of it. Yieldcos. Yieldcos were sort of a thing that have existed in different shapes and forms throughout investment history. We've got, there are Canadian types, there are MLPs, which are sort of like that in the oil and gas space. In renewable energy, they came up in 2015. There were some agency issues in the way they were managed, and that development companies owned the asset companies. But fundamentally, they were created to take advantage of PPAs. Contracted renewable projects private. So I put this a little bit further over. These are lower risk investments. Truthfully, if they're done right and the investment dollars go in at the right point in time, they can make a very nice yield and be lower risk. And then on the far end are green bonds, and green bonds are bonds, and bonds are great. You know, fundamentally, there's a strict level of underwriting that goes into it, and you end up with a pretty good thing. The risk profile of an energy project, okay? So let's talk particularly about projects. This represents your risk. These are sort of your dollars of risk. A lot of people talk about, I want to do a project on campus, or I want to invest in PPAs, or I invest in projects. Well, when you invest matters. This green line represents a de-risked project, essentially, that has not been built yet. But there's a very long life in front of that, which the development is taking place. And during that development period, again, you've got dollars at risk. The project may not get built. Your risk is binary. Once it's built, it's really, and if it's done right, it's really a cash yielding asset. Getting to that point is complex, and you need experts to work with you. Privately held, this is what a renewable project should look like. You have a large capital outlay, you sell the power every period, under a contract, fixed price, pretty regular. A lot of people say, well, I don't like illiquidity, I need liquidity of markets. Public yield codes, so this is the S&P 500 in the bright blue versus a number of the public yield codes before sort of the disaster period. But what you see is these big shocks in the middle. The price of oil dropped. Renewable energy projects generally should not drop when the price of oil drops. That's markets reacting, impacting what should be a 20-year fixed asset. So there is an argument to say maybe these should be done through private investments, private vehicles. The last thing I just want to talk about is the asset allocation model. And it's, you know, it's sort of a foundation of what many endowments, what folks look at. This is from a 2013 Cambridge Associates sort of chart. Traditionally, energy investments have been sort of grouped into this diversified growth. They compared against private buyout, compared against venture capital, opportunistic real estate. And I'd say if you're investing in E&P, in oil and gas E&P, that's probably right, because oil is very volatile. When you start to talk about a 20-year PPA with a capital cost with no variable input cost, which is what renewable projects look like, you really need to think about your real assets bucket, your fixed income bucket. We're talking about a much lower risk investment. It's a very different type of product. And I think, you know, the conversation with consultants, with endowments, with institutions really needs to begin around that, which is rethinking how you, where you put this asset into your portfolios. So these are sort of the 3 points I'd say. It's not an appropriate investment classification by itself. Owning contracted renewable assets, very regular returns. If owned and structured properly, it's not a simple thing to do. And then the timing of when you make that investment really matters. So thank you very much.
Based on the questions that I've heard and the slides we've seen over the last day and a half, the leaders of university investment absolutely get it, that we have to put money into solving the 2C problem raised in the Paris agreements. The question is not what do we have to do, it's how. How do we move the needle? How do we make sure we're doing what we want to do? These questions have been asked by investment professionals all around the globe. My colleagues are offering a great number of interesting programs on this, and I want to talk about the one that I know about, which is fixed income and bonds. A great deal of the money that needs to be raised, the $90 trillion that's been bounced around since the climate talk, will need to be raised in the bond market. The bond market is bigger than the equity market. Generational equity calls for spreading the costs over the life of the asset, which means repaying the costs over the life of the bonds. And finally, a lot of the players, the entire public sector, can't issue debt. So a lot of this money has to come from the bond market. On the other side, it's likely that endowments and universities and pension plans are going to play significant roles in funding that. An allocation to bonds, as John has pointed out in the last presentation, is appropriate, and there's several good reasons for that. Bonds offer a stable, predictable rate of return. You have very, very different dynamics of pricing in bonds relative to stocks, and that tends to stabilize your value of your portfolio over time. And finally, you have a more direct benefit in investing in a project through bonds than you do in the diffuse world of public equity investing. So you've probably heard the term green bonds. Green bond is simply a bond issued to finance a green output or a piece of infrastructure. Any borrower, including a university, can issue green bonds, which means that you can be long them or short them, and you can finance your infrastructure side projects with them, or you can own them in your endowment. The issuer of a green bond doesn't have to be, by definition, a green entity. Many business or as usual organizations, private corporations, banks, manufacturers, have issued green bonds to finance their green infrastructure and processes. So in the market so far, we have seen no systematic cost to investing in green bonds relative to the general market. And that means that the rational investor who can add the green impact to their investment without any cost is a likely buyer of the green bond. To date, most of the green bonds have been clean energy plays, energy conservation, and mass transit. There's about $700 billion outstanding. That's less than 1% of the total float in the bond world. Issuance is global, and there is a huge dispersion of ratings, maturities, and currencies. Some green bonds, by definition, are greener than others. Some projects are greener than others. And in the same way, some bonds are longer than others, and some bonds are higher or lower rated than others. For investors to treat all green bonds equally blunts the effort to maximize the positive impact that you have in investing in them. We have common language and metrics about return, but we don't have, and we ought to develop, common language and metrics for the environmental impact return. And that's part of what I'm about. Both Moody's and Standard & Poor's began this year to offer green ratings for new bond issues. This promising effort is still very preliminary, and it really hasn't reached market penetration. I've been buying green bonds for clients with environmental mandates even before they were called green bonds. And I created a classification and scaling protocol. My intention is to make this overt and transparent so that we can use it together. My system uses publicly available data to identify use of proceeds. It extends the shades of green methodology, light, medium, and dark, that was developed by the Cicero Center for International Climate and Environmental Research in Oslo, which provided confirming second opinions on about 70 green bond issues over the last decade. In both of those scales, the highest impact, the ones closest to me on the table, are things like wind farms or LEED certified buildings. They would be dark green. An undifferentiated basket of green projects might be medium green or light green. And a fleet of conventional transit vehicles would be very light green. General purpose bond would have no apparent impact, and we'd call it gray. The point is, in the absence of defined and widely accepted green impact metrics or bond labels, we've got no cohesion. We've got a lot of people talking in silos about their projects, about their methodologies. I suggest that if we want to move the needle forward, we want to do this in a consortium, in a nonprofit way, and in a collaborative way so we agree on what we're talking about. And I think that both IEN and the World Resources Institute, probably in the conjunction that's coming next month, ought to be a good place for this. This is the kind of work that can be done by students, so there's an educational component to it. There are available data sources that are free and absolutely transparent, and they can be used by the universities. I'd like to continue this conversation in the open space, and as we talk about it together, maybe we can move this needle forward. Thank you all very much.
Yeah, I'm an investor. I worked with Luther College. The college and I have been working together for probably about 10 years on their climate control programs. Anyway, Luther College is located in northeast Iowa. It's a beautiful place. It's actually a crater that was developed by what would develop a crater? And so it's really a neat place. Anyway, Luther College signed on to the University President's Climate Agreement in 2007, one of the first colleges to do so. The college has been tracking carbon emissions since 2004, and in 2007 established a carbon emissions goal to reduce carbon by 50% in 2015, 70% in 2025, and 100% in 2030. The 2015 goal has been met. Iowa has a lot of wind turbines. There are about 3,600 wind turbines in the state. And so one of the things that Luther wanted to do is to build a wind turbine. And so this is, well, you can see the valley there and how it builds up to that hill. That actually goes around the whole community. So, but there's the wind turbine at the top of the hill. Northern Iowa has a great wind regime, but as you get over into the area that we're in, it's less of a good wind regime. So anyway, getting it at the top of the hill was a big help. I had also built a wind turbine, a large wind turbine, about 4 years before that. And so we were on the same page. We could talk about all the issues that relate to building wind power. And so let's move on to solar power, because it looks like wind power as an opportunity for all of us is going to be pretty limited. It's pretty much owned by the large utilities in the state. And so community wind power is probably not going to happen. So we began that discussion of talking about solar. I tried to do a project with the utility, did all the documentation to get it ready, and the utility turned me down, so we had that conversation with Luther, and we built this 280 kilowatt array. It's about 1,000 panels, and it powers that village. It's a student housing village, Baker Village, that is all electric. So it was a meaningful project. And the solar panels are not far away from the village. And this was a net metered project, so that the rate, because it's a housing facility, the rate was 11 cents, and so we were able to meet that rate. The next thing that happened was that I tried to do another project in 2015, and with the utility, because solar rates had come down a lot, and so here's this new opportunity. Again, they turned me down, and again, I met with Luther, and we turned that project in 2015 into an 820 kilowatt array. And the meter that's going into is in that athletic facility. So this is third-party power purchase agreement. How it works, basically, I'm the investor, the college is the buyer of the power, and there's the utility in the background that needs to accept the excess power that that may get dumped onto them. That's not going to happen in this case because we've designed the project so they're going to use all the power. So it was kind of an interesting project because when I show the handshake, there's so many things that had to come together with the handshake. And we needed to have somebody that would help us coordinate that. And so we had this attorney that was familiar with all the documentation that needed to be done. So we needed to tie together me, the investor, the college, and interestingly enough, we needed to have a solar contractor that all understood what our primary objective was, and that was to set a good model for third-party power purchase agreements, a community solar project that worked. It was a business transaction. It was not a gift from me to the college. And that's kind of what we wanted to do, is make that a good example for the future. And interestingly enough, in 2016, this project was transferred. We had done workshops at the college to explain this to other people in our region. And interestingly enough, that the next year, the same project was duplicated in a community just 20 miles from Decorah. It was a smaller project, but they still put up a lot of solar panels for the community itself. So there are things that the investor needs to be aware of. This is a hands-on project, so it's different than all the things that we've been talking about so far. But I think colleges and universities could find those people that would fit that hands-on situation. So you get into tax issues that need to be resolved. You need to do the financial planning. And so the one extra thing I just wanted to mention is that in our community, we now have, and this is a community of 8,000 people, we now have 250 solar arrays. We have 5 installers who now install in the whole region. All the support people in the community are involved in solar development. And so it's kind of interesting to see how when a college gets started on a project like this one, how it's spread right throughout the whole community. Thanks.